There's a lot going on here in this slide. This is a new one, but this is ultimately going to be looking at the the Russia-Ukraine situation. The left-hand chart here is going to be three indices. We've got the Bloomberg Commodities Metals Subindex, the Energy Subindex, and the Agricultural Subindex. So the white line is going to be metals. So that's going to be a basket of all base metals, ferrous metals, precious metals. The blue line is going to be your your energy complex, which is going to be crude oil, natural gas, coal. And then the orange line is agricultural basket. You can see that I've kind of cherry picked the data going back to April of last year, but in all three of these markets, we are in very inflationary markets, and we're also in, for the most part, very tight supply demand conditions where even prior to the Russia-Ukraine situation, a lot of these markets were getting pretty tight and prices were elevating up near record highs and in some cases actual record high prices. Fast forward to where we are today, this is where we have to address the elephant in the room. Russia and Ukraine do represent very sizable players within the natural resource space. Over on the right-hand side, the top right-hand side, I've got the Russian market share. So in the center column here, we've got the Russian market share of each of these individual commodities. And it varies by commodity, but ultimately when you look over on the far right-hand side, you can see what percentage of their market share they actually export out into the world economy. So you look at things like crude oil, they're 10% of the world market. They export almost half of that. So you're talking 5% of the world crude oil market that could get sanctioned, blocked off, blocked from purchasing. However you want to phrase these sanctions, whether they're federally backed or whether it's just private organizations, halting purchases or activity with them, this is the magnitude of what we could possibly expect. So we start working through some of these metals. Aluminum, 6% of the world share, 80% of it gets exported. They aren't consuming a lot of their domestic aluminum industry. So that would be a big hit if it gets cut off. Copper, similar thing, 4% of the world share, 75% of that gets exported. Nickel, even bigger, 8% of the world share, 90% of that market gets exported. So this is why we're seeing such volatility and such big gyrations in the price of a lot of these metals and energy products and food products, because they are big in all of these. You work your way down into this bottom commentary. Russia and Ukraine combined are 14% of the global wheat market. So there is a lot of, I'm not at all trying to give Putin credit in this situation, but if ever there was a landscape over the last decade where there was leverage to take action on something like this, we're in it right now, because as we saw over the last week and a half, when the invasion began, both Europe and the United States were very cautious and very slow and potentially maybe even weak in issuing widespread sanctions. And I think one of the main reasons for that, I don't even think it's any big secret at this stage, is that the food security and maybe more drastically the energy security of Europe relies on these supplies. So until or unless there's a backup or a contingency plan, some of these markets that were already tight could get a whole lot tighter. And I think, when we take our prior Cup of Joes into context, we've talked about things like the revenge of the old economy. And we even had a Kanye West reference. We talked about, the shortage of all things. And that was all before the Russia-Ukraine situation. If anything, if this persists, this is just going to make everything that much more heightened, that much more risky, that much more volatile, and likely to the upside for now. This is a chart. This is actually a new one, but I'll give a quick lesson on futures markets, and I'll use a little bit of context with the steel market. What this is looking at is it's called contango or backwardation in the futures market. So what this chart is doing is it's looking at the spot price of a basket of commodities. So it's looking at the front month futures contract, and it's comparing it to the same commodity 1 year out in the future and seeing whether the price is higher or whether the price is lower. If the spot price of a commodity is lower than the futures price, we call that contango. It's a fancy finance term. It just means the current price is lower than the later price. Right now, we're in the exact opposite scenario, which is called backwardation. And that occurs when, in essence, you have kind of a panic buying type situation. if you'll recall, for those of you who joined us on the Cup of Joes in prior months, the steel market, when we looked at the steel futures curves, was very much so in a backwardated environment for about 12 to 18 months. That was a situation whereby we kind of had panic buying. There were backlogs of orders, and it was essentially name your price. Well, unfortunately, that phenomenon is now spreading into an entirely broad basket of commodities. And again, so you can see it across the entire basket. On average, across the Bloomberg Commodities Index, the backwardation is roughly 12 to 15%, which means that on average, there's a shortage of a lot of commodities. And there's a premium that you have to pay in order to get the commodity right now versus several months into the future from now. So I apologize if that was a little wordy. I went a little quick through my explanation, but ultimately what this chart is signaling is that there is a lot of panic buying. There is a lot of scrambling of trying to find contingency plans, backup resources, backup supply chains. And that's really, it's at record high levels as we sit here today. We've talked about this in the past, but this is a slightly different set of indices that we'll reference. We talk about the revenge of fossil fuels. This chart here is actually looking at two different types of coal. So what we've got here is thermal coal, which is the coal to heat your home, heat your facility, in the white line. And then you've got the blue line, which is going to be metallurgical coal. So that's the coal to actually manufacture things like aluminum, things like carbon steel. And this is a 5-year chart. And you can see in both instances, they've gone straight up. And I mean, we've seen a lot of pretty crazy charts. This one may take the cake, that as we have the Russia-Ukraine situation playing out, and there's a real risk of energy shortages, well, you kind of have to go to whatever energy source is next in line. And right now, that's some of the old school fossil fuels. So you can see the price of a lot of these have doubled, if not tripled, just in the last couple of days, let alone weeks and months. So as we think about what this means, and we're obviously seeing it within crude oil, we're seeing this similar phenomenon within natural gas in Europe. All of this is likely going to spill through to higher cost of producing things, higher cost of finished products as it works its way through the supply chain. So this is a little bit of a forward-looking statement. This is Nick Webb's opinion, but if I was a betting man, I mean, I think the subsequent next couple of months, we're going to see not reduced inflation. I think as this works its way through the economy, I think we're going to see pretty rapid rates of expansion in a lot of the inflation data points. So hopefully it's temporary. We will see how it plays out, but this is a pretty wild phenomenon, what's happening within the energy space.
Nick, real quick, in previous, you talked a lot about China focusing on possibly reducing their CO2 emissions. Do we know, are they still focused there, or was that more transitive?
I mean, I say it's a little tongue in cheek.